Welcome to the Jay Tyner Show, where we discuss all things wealth management and retirement planning. And as always, the goal of our team here at Semmax Financial Group is to help you focus more on your life and less on your money. Now, as a reminder, check with your current advisor, planner, CPA, and read our disclosure in the video description below. Subscribe to this channel if you want to stay up to date on all of our new content. And by the way, if you have questions or need a 15-minute free consultation, please visit semmax.com or call 336-856-0080.
Hey there, everybody. Thanks for joining us on the Jay Tyner Show. I'm Jeffrey Griffin, along with Jay Tyner, best-selling author, Tsunami Proof Your Retirement, along with Matt Landon. This is part two, and we hope these tax breaks are not going to be so overlooked after we get done. We'll jump right back into it. We're going to start with Matt. What is this pension payout trap? Something I should be worried about?
Absolutely. So oftentimes when people take a pension, they want to take the lump sum distribution, and they have different things they want to do with it. Maybe they want to take a piece of it and pay off part of their home. Maybe they want to put a portion of it into an IRA, but they want to take it and kind of parse it off a couple of different places. Now, here's the thing. When you take that lump sum from a pension, if you have the pension company send that check directly to you, they're going to withhold 20% and send that off to the federal. Send that straight to the IRS. They're going to go ahead and do that. You don't have a choice. They're automatically going to withhold that. Right. Now, the issue is, if you want to take that money and you want to turn around and reinvest it, and you're saying, wait a minute, I didn't want to take this as income, and you do that 60-day rollover, well, now you've lost 20% of that value that you have to try and get back come tax time and move it in, and it's a huge headache. There's a really easy way to avoid this.
I'm for that.
Have the pension company roll that lump sum directly to your IRA. So when they do that, there's no taxes withheld. The full balance moves over. If you did need to take a portion of it, you can take it directly from the IRA, only pay taxes on the portion you're taking as income, and you can avoid this very common mistake or very common trap that people get caught into, and it makes your taxes a whole lot simpler at the end of the year.
Just skip that hole entirely, right?
Just avoid that pothole. Just work
Drive around it.
There you go.
I love it. Now, Jay, RMD.
Yeah.
Help me out.
Well, you have to take your required minimum distribution. Now, during the COVID situation, there was some relief here. The IRS gave us some abilities to where we did not have to take that minimum required distribution if we were over a certain age. And by the way, that age has gone up. I think everybody knows this now, but if you don't, your RMD used to be at age 70 and a half when you had to start it. Now it's gone up to age 72, right? Mm-hmm. So you got a little more time before you have to take that out. But the key here, I think the key is, how are you taking that distribution? Are you taking it day one of the year, or are you taking it at the end of the year? If you start taking it at the beginning, then you got to send in for taxes, right? Because remember, it's as earned. So if you took a distribution and that showed up, you got to pay that taxes more along the lines of a quarterly distribution. You got to pay taxes as you take it. Some people don't necessarily need that RMD, and so they can wait to the end of the year. Maybe you take it out in December. Mm-hmm. And then when your taxes are due, they're going to be due like the next month. Mm-hmm. Well, you were going to pay them anyways because that's next year, right? You see what I'm saying? So there is a way to, I wouldn't say cheat on it, but there's a way, a workaround, right? Is that the appropriate way maybe to say it? There's a workaround. Now, if you have to have the income, you got to have the income. There's not much you can do there. I would say, though, is you want to be able to strategically work this so that your estimated tax can be handled with those distributions that you're already taking and paying taxes out. So it's a different way of saying it. If you're taking the RMDs and you're taking them out throughout the year and you're having the withholding, that might be enough, right, for this other little side thing that you had as income. So again, I would come in and have somebody kind of crunch the numbers on the taxes for you.
It's not an insurmountable issue, is what I hear. Now, Matt, this may be my favorite tax break. It's certainly one of the feel-good tax breaks that we're going through today. Giving. Seems like such a wonderfully simple idea.
Yeah. John Maxwell, I heard him speak once, and he said, do your giving while you're living so you're knowing where it's going.
I
love that. I like it. Now, here's the fun thing about a QCD, or a qualified charitable distribution. Couple things. One, that can count towards your RMD. So you have that required minimum distribution. If you send those funds directly from your IRA account to the charity, whether that be a church, whether that be a mission that you're a missionary or someone along those lines, or another charity that you want to support, right? When you send that directly to the charity, it doesn't count towards income as you. It covers that RMD. And what's great is if you're taking the standard deduction, for most of us, that standard deduction is so high, we're not getting the benefit of itemizing. Right. You're still getting that same added benefit as if you were itemizing that charitable deduction. So if you're in the situation where you're tithing every couple weeks, or you do charitable donations near the end of the year, it may make sense to take it directly from your IRA.
Love it.
But it has to be has to go directly
Correct.
from the IRA. It can't be cleared through your
Correct.
checking account.
And that's the key thing is it's going direct from the IRA to the charity.
So if your IRA custodian, say, is Fidelity, it would have to be a check written from Fidelity to the church or the charity of your choice. It has to go directly from them for your benefit.
Now, if you work with your advisor, they can set that up for you. It's not an insurmountable thing. But like anything else, when it comes to the IRS, you got to follow the rules.
Yep.
This is not putting it in the plate or the kettle.
Correct.
A little bit different. All right. Well, another really, it seems like a wonderfully wholesome thing is you can give to your family, Jay.
Yes, actually, you can give to anybody, but you can only give $15,000 per person. So I could give $15,000 to you. I could give $15,000 to you. I could give $15,000 to your wife. So my wife could give $15,000 to you and $15,000 to your wife. So basically, if I'm let's say my wife and I wanted to give to our son or our son-in-law, we could each give the $15,000. None of that's taxable when it comes to the death tax or the estate tax. Just want to make sure it's qualified, that you understand not all taxes. There's many different kind of taxes. This has to do with the death tax.
Yep.
Go ahead.
Now here's the key thing with that. Let's say instead of 15, you really wanted to give me 50. But you said, I don't want to pay that 40% in taxes. I just gave myself a raise here, right?
Smart man.
You can do that. But when you do that, you're just writing it off against that estate, right? So you're reducing the amount your estate can pass on, but you don't have to shell out that 40% tax on anything over that $15,000.
But your estate would have to be over $11.7 million.
Well, so let's say you gave me an extra $1 million.
Okay,
right?
yeah.
Now you can only pass on a taxable estate of $10.7 million.
Yeah, that's a down payment on the million.
I'll take it. He's not getting this back.
Wait a minute. Money.
Yeah. So even there, if you go over, you don't have to pay that huge tax bill now.
And every dollar that you can hold on to helps.
Absolutely.
In the big picture. All right. So, and here as we wrap up our most overlooked tax breaks for retirees, the vacation home.
Right. So let's say you have a vacation home. Everyone knows, or I shouldn't say everyone, but a lot of folks know, if you have a second property and you sell it, you're going to run into some capital gains. But your primary residence, you've got a really big exclusion, right? That you can get away with a lot of gains inside of there before it hits you. So what a lot of folks have done is you might sell your primary residence, right? Move into that vacation home, that second home, stay there for a couple years, long enough that it's inside.
About 2 years.
2 years. You have to minimum of 2 years, right? But it could be longer. And then you're able to offset some of those capital gains. You don't have to pay that entire tax bill. But I know you wanted to touch on this as well.
Well, there's one other thing. A lot, especially here in our area in High Point, when the furniture market comes in, a lot of people rent their house out.
You go on vacation for a week.
And you can make some pretty nice money. Well, there's a way to do that, and it has to be noted on your taxes as a 14-day rental. If you classify it as a regular rental, like a 365-day rental, then the IRS thinks you're a landlord, all right, and you got to pay taxes on that income. But if you do it as a 14-day rental, all that income's tax-free. So just wanted to throw that out.
Good to know. Yeah. All righty.
So, are you renting your house out now?
I'm thinking about it now. You all have put me on the right path. Okay. So the most overlooked tax breaks for retirees. We hope it's been helpful, and we want to keep you focused on more of your life and less on your money. If you'd like to learn more, visit us online at semmax.com or give us a call, 336-856-0080. I'm Jeffrey Griffin for Jay Tyner and Matt Landon on the Jay Tyner Show. Thanks for watching, and we'll see you next time.